All right, let's take a look at what happened today and get an idea what's going to be coming up going into tomorrow. The first thing, if you remember yesterday, we were looking for was to see the market move up and get past this green line here, which we were able to do almost immediately last night. As soon as the market closed, it popped up and got over that level. Moving forward from there, the objective, if you remember, was to trap in some bears and use them to pump the market higher. The bulls needed to be able to not just defend daily tension, but also to be able to pump the market further to increase their ability to sustain control over probabilities. So the first thing that happened, you see right here off the open, we get a little dip down. The bulls pick up some liquidity. They hit here. Again, it pushes over, giving us a signal, but there's no trapped volume for bears to show up and try and sell. Decay dips back under, more trapped orders, and they hit again. So we have two positions right here. Those are check marks. Two positions right here by the bulls right off the open, looking to trap in some bears, which seems a little excessive. You know, you've got two positions, you don't have the counterparty to trap in. Well, just after, you can see it moves over, we trap in some volume right there, and the bears do very little as it moves forward, and there's no impact whatsoever as we move through this high. So essentially the bears fail to do anything. And after some time, the objective here was to try and liquidate them. And you could see there was some acceleration here in tension as we moved up, but it wasn't really the type of trap where you trap in some bears, drive the market up, and move things against them. It just looks like the bears did nothing. And I think what happened here was simply that there were no bears coming in trying to sell this. We didn't push the market up high enough to liquidate anybody, and I think that's what caused the market to move down. And what I think the market needed was to find some more bears, but the market's been having a difficult time doing that. We had this one sample right here, which we can mark because I think it's going to be an important level right here. So this is the first sample of the bears, which they didn't take advantage of right there. As we move forward through the day, what happens is as the market moves down, it puts pressure on these two positions. If we just use this green line here, you can see it put pressure on them and continue to put pressure on them, but it never turned tension down, meaning that through this low here, the bulls did not liquidate their position. They did not let go. There was no bulls dropping their positions. The bears failed to hit here. So I am not looking at this as bears successfully hitting liquidity. I'm looking at as bears doing nothing. And then the market drifting around in a range, trying to find some bears to trap in the future, because that's the objective. And you could see that even without bears, the bulls were able to pump tension. But when you don't really have a good counterparty, tension's rising here, but price is not quite advancing the way you'd want it to. Well, after a long time, basically the entire day, you can see right here, we were able to get a bullish sample, and the bulls hit again, pumping it up higher. And you see how it accelerated right there. The bulls again hit. This is the third time we've seen them hit. We have 1, 2, and 3. And right here, the bears miss and cause the market, I think, to just range, because the objective today was to trap in bears, get them upside down, and run the market against them, because the bulls could do that. And we've been having a difficult time making that happen. Now, if we use this as a switchback, which I think it's marked out, you can see it dipped under for long enough. If it's only under, velocity is only under for like 1 bar or something, it's not going to trigger. If it's under for a bar or 2 and then pops back up, it's treated like a switchback and it'll trigger. And you see there's trapped orders right here. So I think right here, we caught a couple of bears who I think were probably looking at this saying, well, this could potentially have worked, so maybe we could hit again and see that move down. And you could have been looking at this saying, we've trapped these two positions upside down. But I think the market leaned back down, not because the bears were successful, but because the bears were so inactive that it was tough for the bulls to pump the market up against them. If you just take a look there, they did absolutely nothing for quite a while. This section right here just simply grinded against them because there was no activity. I think this was the goal the entire time, was to find some bears to convince them to trade. They traded, it failed, the market popped up, and now the market is looking to liquidate this group. And I think the liquidation would easily, you could target it as right above the high where, this position originally showed up, and that's going to be the spot where that all these people who participated here are going to have a hard time holding on. They're going to know they're wrong. Just moving this up to here may look like a defensive position, like it moved up to the previous bearish position. Okay, that's not too big of a deal. It'll come back down. But I don't think there's bears sitting here. I don't think that this bearish position did anything at all. There was no impact. There was no response. There was just nothing. So I'm looking at this position here as the one that got trapped right there. I'm looking at this is the bullish position. Velocity made all the way down, finally sampled right there. They trapped them in. You can see that spike up right there in price. They finally got their objective, which is to trap in some bears. It took off. It's moving up, and so I think really the position to look at is the backside of this. This right here is going to be that's the new bearish position that's in trouble. And this right here is the objective, to convince them that they're wrong, because they're going to be looking at this position as the one that, it's not too, see that right? I think this is like, it's not too big of a deal. Let's just move back to our friendly bearish position and we can move this back down. And the bulls have what they need. There's one big issue here that's going to be coming into play tomorrow. We have negative 65% tension. So that means tomorrow we can easily be looking at an elastic day. If the bulls don't show up and take advantage of this and push this higher, which I would expect overnight to pop up, to pressure that, see if we can make that happen, it would be great to see it open up there. And then tomorrow we see the bulls miss something like this, and then prices come down and we get elasticity where the market can ride down, and then the bulls can have another chance to pick it up as it gets closer to zero. And it's looking like that's probably the gameplay for tomorrow. The bulls were able to trap in some bears today. The bears failed miserably twice. We have tension much higher. And if you remember yesterday, there was some thinking, I think yesterday, to look at elasticity, but it wasn't even a possibility that I liked. It was like negative 17% or something like that. And I was like, this is too low. But now that we have 65, we could open up tomorrow. We could see higher, or just open flat, 65%. That can work for elasticity. But that requires that one, bulls fail. That'll be the nod. Two, bears hit, less impact. So they're going to have to hit and impact tension, because if tension's not releasing, it's pointless. And then three, they'll be looking to zero. So once you get elasticity in play, the counter trend traders are looking to get that tension down to zero and try and ride whatever wave they can get. That's what we're looking at, I think, for the play tomorrow morning, afternoon. If and only if the bulls screw up. I pointed out, not because it's going to happen, but because with this, it is a likelihood that I think you need to be completely aware of, so you're ready to go when it shows up in front of you. Elasticity can look like a lot of things. It could move down aggressively. It could move prices just a little. It's hard to tell exactly how effective they're going to be. What's important about it is that it's approved by the controlling party and they allow it to happen, and that's what makes it successful. So that's the thing I'm going to be looking for tomorrow, is to keep my eye out for elasticity. Otherwise, I think tomorrow is going to be more of the same of what we got today. And today was sort of frustrating because the bears waited really to get trapped in till the close. We could see that because the bulls showed up and they were able to hit it against. And I think we're seeing a little acceleration here. We have two positions. This one was just really weak. So I think today was a little confusing. I think people were not on the same page. I think it was a difficult day for a lot of people to participate in. The structure was a little fluid. And I think this has to do with what happened on Monday, which is a majority of the market tried to revenge trade the pandemic V. And today, I think a lot of people threw their hands in the air and said, I don't want to participate. So they were having a hard time trapping people in. You can't screw people over if nobody's playing, which means you're going to struggle to make a directional market. Directional markets are fundamentally based on the transfer of money from losers to winners, from the masses to the few. It's always true. There's no condition where that's not the case. Otherwise, you're asking the big players to do all the work, and they don't like doing all the work ever. It's not in their mentality. They want you to do the work and them to make the money. So I think with everybody throwing their hands in the air today and being a little frustrated, it was a tough market to say this is going to get really directional. But I think that tomorrow when people come back, maybe emotionally come back, that we'll be able to pick up some directional moves. It, I think, is important to note that today did find bears, and they did fail twice. And the bulls did hit 3 times. And so tomorrow, now that the tension's pumped a lot higher, keep your eye on elasticity. Make sure that you're aware of that. Otherwise, if we don't get elasticity, we could continue to see tension maybe slowly rise, or, another day where we just sort of get not a lot of motion out of tension while it inverts higher, which an inversion, of course, is going to be looking at these charts where that you are trying to get a tick high. Maybe we get the tick high like here, and then it like grinds over that level. And this could drive prices up if you get an inversion. You have, that can drive prices up without needing to pump tension a lot, because it's sort of using the natural gearing of the market to drive things higher. That's a total possibility as well. It'll be set up by trapping in bears. The bears fail to run the market. The bulls pick it up and run them in upside down is going to be a similar story. And then you see that inversion, you start to get that grind or that bleed up that you're probably familiar with. So that's what I'm looking for tomorrow. Those two scenarios, either it's going to be a grind, kind of a bleed up, pop out the top, or we're going to see elasticity, and both of those will be defined by the players and what they're doing. If you're not tracking that, you will be blind and incapable of knowing what's going on. You're not going to be able to say, well, I can just pick up on it because of the way price moves. That's just flat out silly and wrong. You need to track the participants based on the way they're consuming liquidity and impacting the market as a result. And then you can see what they're doing and see if we're going to grind this up or if we're going to get an elastic market and burn things down before we run another leg. I don't think that this is bearish. I don't think we're coming down and going to see another leg down, at least at this point. I do think today showed a little weakness on the bulls' part, their inability to generate counter trend traders to take advantage of. I think that took a long time, and I think it showed weakness on their part, because a good, strong player can create the counterparty or stimulate them or get them in and make that happen really well. And today, I think the bears struggled. They couldn't find, or the bulls struggled to make things happen that caused bears to participate. I think it was, to some degree, a fairly expensive activity to find these bears, meaning they had to turn these two positions upside down and negative in order to generate that activity. And that was kind of expensive. So I think we're seeing a little bit of weakness from the bulls, which you need to take into consideration. And that's why I'm leaning tomorrow towards elasticity versus a grind higher, because of what we saw today. We've seen similar stuff like this, where you see a little bit of this weakness where they can't quite make it work out. And that's a predecessor to the structure showing up and conditions and sentiment starting to shift beforehand. So that's what I'm seeing here. I'm anticipating elasticity tomorrow, but make sure you see it before you see it. It'll be really tempting to think that you know, and you can't know. You need to see empirical data points that say, here's the liquidity, here's what they're doing, before you let yourself believe it's happening in front of you. Otherwise, you just get duped. Markets can sing and dance exactly like you wish they would sing and dance without ever actually singing and dancing. And so you're sitting there thinking you're seeing it, and you're not. You need the data points. Don't get excited. Wait for it to happen. The trade will come to you. Miguel said, bulls getting pressured like that as not liquidating means they were front running something news. They tolerated a big amount of risk. Yes, you're right, Miguel. They were tolerating an excess amount of risk for some reason. And we can't know exactly what the reason is, but we know there was a reason. And so I'm saying there was some risk coming in that they were a little weaker because they had to tolerate that risk for some reason, which I don't know exactly what that was. There could be something coming. And as far as I could tell, it would be a bullish thing coming. Otherwise, you wouldn't tolerate that kind of risk. You wouldn't hold your position upside down. You just let it go and reposition at a better spot and don't worry about it. So you're right. They did tolerate an excess. So Miguel's talking about this, how there was a bullish position here and here, and then they tolerated this amount of risk right here, and they didn't let go. And he's right in that that risk lets us know that there's some reason to tolerate the risk. And so we can anticipate that the bulls see something that we don't see. And that's why they held on. They didn't let go. They were fine with that. So that's something that you can have that insight to. That's why I'm thinking that we could see a move up, up. We liquidate these bears into their nice little safe spot where they're like, well, these guys, and here's the high, sure, right up here. And then at that point, we could maybe look at some elasticity. There's something that they're seeing, I think, and that's a really good point. Phil says, is there a tension range on 30-minute or daily where bulls tend to want to offer elasticity? You get some cooling tension, negative 60 size, he's bullish. Okay, so you're right. The range is essentially 70 to 70. We see outside of the range, so you're going to see 70 to 70 because it goes to 100. I mean, if you get this to 100%, there's a wall there. You can't get to 100%. So things get to about 70, and then at that level, what the market wants to do is burn that high level of tension before continuing. So there's a negotiation that goes on there, which is if the bulls are in charge right now, right? They're saying, well, we can only go up to 100%. And they say, okay, bears, hey, do you guys want to make a little money? And the bears say, sure, we'd like to make a little money. They say, all right, well, we'll step out of the way and let you drive the market down. Easy breezy. So they drive it down. Prices come down. Then the bulls say, okay, now we're not right up next to 100%. And then they pick it up again and they pump it back up. So prices come down a little bit. The bulls get a better price. They drive things back up and higher. And so it's a negotiation where it's like the bears can make some money and it gives the bulls a chance to not be pushed up against that limit, the wall that's there. And so elasticity is sort of like, it's up, so they let it come down, so they get a rubber band. The bears get to bring that rubber band down. Then the bulls push the bears out of the way, grab onto it, and it spring loads them out the roof. And that's why I call it elasticity, because the bears are not actually taking control. They're being approved to drive the market down. So that's the cool off that you're talk about. And I think that 60% is getting up and it's high enough that could be a reasonable thing to negotiate with the bears. You could say, hey, let's do this. And the bears will say, okay, sure. So that's why this right here, 65%, is high enough that we could see that. At 17%, it's like, well, where are you going to go? Like, how far down is this really going to go? And there's not that much room. So I don't anticipate them making that negotiation with the bears, at least not very successfully. At this point, we can sort of predict that that's something that might happen. John says, where did I get my trading philosophy from? 12 years of banging my head on the wall. I should write a book. So I've thought, he says, have you ever thought about doing a question and answer session? Yeah, I have. And I try to answer questions here. I'm just sort of making this happen. I don't know if there's like a most effective way to do this. Transferring information or sharing or teaching is just a difficult thing to do online. And I tried a bunch of different things and just going for it. I'll just do this every day and try and answer questions and see if we can make some awesome stuff happen. But I have thought about it. In fact, Joe and I had a conversation just yesterday on the phone about trying to do something a little bit more podcast oriented, where we can do some call-ins and talk about trading and philosophies, and a little bit more engaging. It might be something that we do in the future here, but yeah, right now we're just going for it, just trying to make things happen. Miguel says, was there open interest theft today? Okay, so open interest theft, I don't think so. I think there could have been some in this move down here if you didn't which most people are not going to want to tolerate this kind of thing. You're not comfortable with negative numbers. So there absolutely could have been open interest theft in these dips. But the way that I'll look at open interest theft is I would have need to see this curl down, something like that, where you see it curl. At that moment, I would have said, okay, they dumped their position. And if that dump correlated right here with this low, I would say then at that moment that was open interest theft. But I don't see that, so I'm not calling it that. The other event would be if you have a decay retest, which you could look at these as decay retests here just fine. And you could see that the bears had that, and they were able to move the market down, but they weren't able to cause those bulls to liquidate. So I don't see open interest theft. What I see is just that higher tolerance for risk, which is one of those things that's really hard. If you're sitting here trading this, it's hard to know that they're going to tolerate risk more going through here. It's something you sort of have to wait and see, and you're like, oh my goodness, they did that. And then at this point, you could start to say, oh, they're getting it back up, and you can start observing that. And then when you see that bullish position, one of the things you can add to the conditions at the moment is to look back and say, that's what happened, and therefore I have opinions about this position here. Otherwise, I don't really see open interest theft today, other than that a lot of people probably didn't want to tolerate that risk along with the institutions who did. But I don't like to track anyone who's not an institution. You don't have enough money for me to have interest in you. So if people did dump, it's just a risk tolerance thing. But I could be wrong. I may have missed something. And if you see open interest theft and you say, I think this was open interest theft, I'm all ears. I don't know everything. I could just be wrong. Sometimes I get biased and overlook things. John says, gap up, bulls step aside, bears take elasticity approved, allows for burn off. Counterparty to trade against, possibility of daily zero test, but that would take a lot, I think. John, I agree, it would. The reason that I'm bringing it up is to make sure that we're mentally prepared for it, so that when it happens in front of you and you're sitting there looking at this and you see it happen, you go, oh, okay, we're running into that. You can pick up on it really quickly. Because one of the things that I think traders don't realize is that when you're going through something and you have these data points coming, you'll stretch things out because you get hyper focused on something, and then 20 minutes you've been watching it. And while you're going through it, it feels like just a moment, like boom. But you could sit there and watch it for 20, 30 minutes, just playing out, stretch. Then you go, wait a second, this is the wrong thing. And so I think it's really important to have those possibilities drawn out, the up and the down, the flat, all the different ones drawn out, so that when you see one start to play out, you're already mentally prepped and you can see it happen. Plus, I think it's likely in that we're getting up to the higher levels of tension. So this is a very common event to see. So it's about that mental prep. Just making sure you're ready so that if the events start playing out, you can quickly go, oh, I see what happened. And you can react more quickly. Because I've been surprised in the past where that I'll be watching something literally playing out for 30 minutes, sometimes longer, and you just don't realize what you're looking at because you weren't mentally prepped for it. When you add risk to the mix, it messes with your perceptions and stuff. So I bring that up for that reason, is that it will take a lot of work, but if you do start to see it play out, you're going to go, oh, I know what this is. And then you have the chance to react more quickly. It's such a bummer to see something after it happens. and realize that your reaction time wasn't quite quick enough to do anything about it. I always feel like that's such a bummer, and it has everything to do with your reaction time. Your ability to pick up this right here didn't have to do with your ability to see it. It had to do with your ability to recognize what was going on and sort of have it maybe about here in your head. Like you have this idea. That's an I in there. I for idea. You have the idea in your head, and then as things play out, then you see the idea show up and your reaction time gets cut way down. But if you're not ready for it, then you'll see it playing out in front of you and you won't react until like here. And you'll be like, oh my goodness, why did it take me so long? Because you'll question yourself or you'll make terrible decisions. I don't know, one of the natural things for traders to do is to assume, and this is normal, is that if you're not prepared for this long right here, showing up, then your natural thing to do is to multiply it by the inverse, like -1. And you say, it's not real. And then you start to see the failure. So if you're not expecting something to happen, it's really normal for people to think that the opposite will happen. I don't know why it's such a human tendency to do, but that's what people do. And so if traders, for instance, come in and they hear me say something, let's just say, and I'm like, oh, this is going to move up. Well, if you're not prepared to hear that from me, and a lot of the times there's this natural inclination to say, well, oh, I think he's going to be wrong, and to try and trade against it. It's not that that's a good or bad decision. It may be a good decision. I might be wrong. It's that it's a natural human bias to assume that things that you're not prepared for are wrong and that you should go the other way. It's just what people do. So I'm a big proprietor of be prepared. Build your expectations so that when you see things happen and you're meeting those expectations, you don't make that horrible mistake of thinking the opposite will happen because you weren't prepared for it. I don't know why humans do that. I don't know. Maybe it's a safety mechanism that we have. It's like, if I weren't prepared for it, destroy all things that I'm not prepared for. It's that unknown fear. I don't know. So maybe that was a long-winded answer why I bring these things up, but I think it's really, really important that you already have everything mapped out in your head, the up, the down, the sideways, the straight up, the straight down. You kind of understand how those will work so you can react quickly. And I find over and over, markets tend to do exactly what you want them to do. And that is the hardest part of trading. It just is. Once you figure out how to read a market and once you know how to build an expectation correctly, you'll start getting what you want. And that starts to be difficult because it comes with all these strings attached that you don't see until that they happen. And then you go, oh my goodness, that means that when I'm getting what I want matters. And that means I need to pay attention. And it has this high cost to it that you don't see until it really happens to you. And then as you're getting what you want, you see things play out and you need to act in an honorable way, in a way with integrity. It means when you're getting what you want, you act like you should. And when you're not, you act like you should. You exit when you should, you enter when you should. And it creates these demands on you. You don't realize until it's happening to you. And then you go, oh, this is like a real thing. And most people never get there. Most traders never get to the point where that what they want means anything. And so most traders don't ever get to experience that. Most of the time, people get those types of things if you're running in a managerial position at a company or something. And then what you want suddenly matters, and it puts all this burden on you that you didn't see until you were managing and you were in charge. So I build these expectations so that I have clear roadmaps, or at least expectations, so that when I'm getting what I want, I know what's coming and I don't have to come up with it in real time on the fly, because that's just a lot of unnecessary extra work when you're carrying risk. John, you said, does the tension indicator work on anything other than the SPY? Would it be applicable to things like the Qs? Yeah, absolutely. Yeah. In fact, I can show you the settings. One of the things that you can do, I use the New York Stock Exchange, of course, but you can change the stock grouping or the correlation. So there's a bunch of different ones. I use the NYSE, but if you wanted to just look at the NASDAQ or all of the US, or, these are the ones, and then you can use the composite or the primary advanced declines, because there's a bunch. You can use those. I like the New York Stock Exchange one. It's the one that I cut my teeth on. So I love it for, it's the one that I love. I also like the composite better than the primary. And most people use the primary. I think I like the composite better. It's just my preference. So you can use it on those. You can use the New York Stock Exchange one, which you can see right here. It says New York Stock Exchange composite. So when you switch that, this will switch, so you know what you're looking at. And it'll tell you if it's composite or primary. And you can plot that over the Qs or whichever one you want to do. And it tends to be that each index has its own little personality. For me, the Qs are like getting slapped in the face. They're so whippy. Like, they rip up and they rip down, and the moves are they're wider, they're messier, and I feel like the Qs just have this, I don't know, it just feels like they slap you a bunch. And I like the SPY because it used to be that when you're trading the ES, it's slower, it's more structured, it tends to do, when you get it right, you really get it right. And the Qs, when you get it right, sometimes you have to tolerate some crap. So that's just my opinion. You know, I'm sure there's some people who really connect with the Qs, and it's innate personality and stuff a little bit better. But I'm familiar with how the SPY reacts to things like high levels of tension and low levels of tension. And the Qs will have their own personality about it, but they essentially do pretty much the same thing. You get advances in prices and stuff like that. And the same thing is true with the with trapped orders. I'm looking at the stock grouping for the New York Stock Exchange. So I'm looking at the New York Stock Exchange. You can look for trapped orders in any of the exchanges, and you can use primary or composite, and that will look for these trapped orders on whatever exchange you would like to observe for those things. So I use the New York Stock Exchange because it's my favorite. And I mix that with trading the ES and the SPY and stuff like that because that's what I like. So you guys are all just sort of stuck doing what I like because I'm doing the videos, but it fits on whatever you're looking for. What about time frames? So you could switch it. Now, what's important about this is one of the most important philosophies you can ever run up against is the MTF, which is multi-time frame. And multi-time frame means a lot of different things to a lot of different people, but the proper way to look at this, the only way that really works, is that if you're going to trade a 1-minute chart, you're going to trade here, you need analysis from two other time frames, and they should be at least a 5-minute, at least, and something that's a significant multiple, like a 1 hour. I use a 30-minute and daily. You need 2 higher time frames, and the multi-time frame functions like this. When you have prices move up on a 1-minute chart, you want something like a 30-minute signal or some 30-minute condition, where on a 1-minute chart, it's a pretty significant move, and on a 30-minute chart, it's basically nothing. And you're going to take advantage of the precedence of higher time frames because there's more money up there. And so as you work your way up, you need to be comparing a high level one, like a daily or a monthly or a weekly, to a more intraday one, like an hour or a 30 or 5, and you should be operating on a much lower one, like a 1 or a 2 or a 3. And multi-time frame functions in that your analysis is always much higher while you're operating, meaning how your profits, your stop losses, how much money you're looking, or how many points you're looking to take, are much lower. Otherwise, you'll think that a 30-minute time frame signal means 30-minute time frame profits, which is just wrong. 30-minute time frame signals will give you 1-minute profits. Dailies will give you 30-minute profits. You never take a daily signal on a daily chart, ever. It's just wrong. It may work, but if you want to be successful consistently, you should stop thinking that way. You take higher time frame signals and you get them on the lower time frame charts. That's always how it works. Always. So with this one, I'm using 30-minute and daily while that I have it plotted on a 5-minute chart. So you can see that combination again. I have a 5-minute for charting, and then I'm using a 30 and a daily. And I like the 30 daily combo. That's the one I use. You can switch it up to whatever it is that you want to use. But if you want to track what I'm doing, you know, 30 daily is the ones that I'm using. So, and you can see that those are settings that you can. So this is the 30, and the secondary, this is the primary one, which is the line, and then the secondary one is that one, and that's the histogram. And so this is multi-time frame analysis when it comes to tension. So John, just so you're clear, I am not using 5 minutes. I'm using a 30-minute and a daily, and they're plotted beautifully, if I might add, on a 5-minute chart. I don't use 5-minute, 1-minute analysis. 30-minute is about the minimum that I use for momentum. I think things that are lower than 30 minutes are just a little too quick to have good responses from the market. Alex asked, why do we not see bull samples when we hit 3192 or near it? But we do see one near 3201.25. Because we do. I don't know. What we're looking for is not, I can't tell the institutions where to trade. I just look for where they can. And we see the signal right here, and we see the volume trap there. You get the signal, then you get the market response that generates the liquidity. I know there's liquidity here. There may be liquidity here, or here, or here, or here, or here. I don't know. I can't know that, but I look for the spots where that I can define the data points, and I can see here that there is liquidity, and I see it there because that's when the velocity crossed over zero, and that's when it created that signal that a bunch of people responded to, thinking that negative numbers mean down and positive numbers mean up, and they made the silly mistake, and it caused them to be liquidity. So I don't know why there was no liquidity at one level versus the other. That's the decision that the institutions made that I can only react to. I can't do anything about it. Burger, what is the composite? So if you have a stock like Apple, let's see, what is that? AAPL? There's an APPL. I don't know. AAPL, I think. If you have a stock like Apple, we'll just do an A. They trade on a primary exchange, which I believe is the NASDAQ. And they also trade on other exchanges. So when you have multiple exchanges for a stock, then when Apple is up, it could add a +1 to the advanced decline. On a primary, if it's on one other exchange, it could add a +2 to the advanced decline. So it depends on if it trades on a primary or the composite. And the composite means that all the stocks in the New York Stock Exchange plus the input from their composites will come in. So not all stocks trade on multiple exchanges, but some do. So the advanced decline with the composite, this one, which is the one I'm using, you see the NYSEC. It tends to be that if the ADD, which is the primary, it should be ADDP to be honest with you, primary, if that looks like this, then the composite might look like a little bit more aggressive and slow down a little bit earlier because it's reacting to more stocks. So it tends to be more accentuated because it has more data points. It's just a personal preference. It's just the one that I personally like. Alex, why does the bear sample occur right after the bull sample? It was a switchback. He's talking about this right here. Why the switchback? When you're sitting there and you see +2, you assume up. You see +1, you assume up. Then you see -1, you assume down. -2, you assume down. This is the philosophy that causes most people to buy and sell. Positive means up, negative means down. They're not interested in context. So right here, we saw that go negative. How many people responded to that negative number? This many, right there. You see that green? It's green because I like to trade against sellers, silly people. And they saw the negative numbers and they tried to sell. I can see that. That's why it's green. Then it said +1. And then we're like, oh my goodness, it's going to go positive. So positive numbers mean up. So did they buy? Yeah, we see them right there. See that? They started to buy in. We see red because I like to sell against buyers. But we were looking to trap sellers. That was the objective for the entire day today. And so these buyers found these sellers, trapped them in, and were able to drive the market up against them. So it's only a switchback for me if it lasts under 0 for a little while. So if it's just like for half a second, I don't count it. But you can see it stayed negative for a couple bars there, and then it pushed back up positive right here, boop. And then we got our trapped traders that showed up right into this dip here. It's not plotted on this chart, but so it has to do with people's perceptions of what a negative and a positive number mean. If it goes negative, they sell. If it goes positive, they try to buy. And that is, that's why it works. And we were looking to trap in some bearish institutions, and institutions sell against buyers and buy against sellers. So it's a little confusing, but it works. Cheese sandwich. Why didn't VWAP catch up to the bullish move end of day? The VWAP is a coefficient weighted averaging model, and it's based on the volume. One of the things I don't like about VWAP is that it doesn't quite keep up with markets very well, but when they get aggressive, so it's not my favorite one to use. If you maybe were talking about the VoltiWAP, why didn't this come up? It's because this is volatility and volume weighted. So it basically tracked that, excuse me, I think I'm going to sneeze. Excuse me. This move down had the most volume and volatility. And that these moves up didn't quite have as much. So they weren't outweighting the volume and volatility in this move down. And you could see that they were ticking up. So we were seeing that it was finding large chunks of volume, volatile volume, at different spots, which typically indicates activity. And in a market like this where we had multiple impulse waves, we had an impulse wave, impulse wave, impulse wave, and an impulse wave. So sort of a getting wider. Then even the VoltiWAP has a hard time keeping up with things that start getting aggressive back and forth and back and forth. It's just there's so much volume and so much volatility. What ends up happening is essentially this, well, you could see it goes like this, right? Well, at some point, the averaging model is going to sort of mean out. And since this had a lot of volume and volatility in this move down, the volume and volatility in these upward moves was not able to cancel it out. So it stayed here. I mean, it's just a coefficient weighted averaging model that's how it worked. I think that it actually does a pretty good job, but it's not looking to, like, I know oftentimes it does stuff like this, but this is not the objective. I don't use this to find buy and sell signals. I use it to model impulse and counter move waves, not entry signals. And I know that it's really tempting to do that, and it's not necessarily a bad idea, but it's not the thing I do with it. If we go back to a day that's maybe a little clearer, this you could see the impulse wave, and then it died off, and it models that really well to let you know when things are in a counter move. I'm trying to find it. Here's a two-directional. You can see the counter. So this was an impulse wave, and this is the counter move, and you could see that all the way up until it finally found enough volume right there at the high that we were so this whole thing was the counter move, and then we finally found enough volume, and that's when it changed the condition into the next thing. And so I'm looking at an impulse here and a counter move here, and then the next, and then that whole situation is sort of done right there. And that's really what I use it to model. And so today you could see that, oh, sorry, if I zoom in a little bit here, there was an impulse down, it moved up, moved down, moved up, moved down, and then we had a counter move up until right here. So we just had a bunch of impulse waves. It was just really aggressive trading this morning. And then we get the counter move up to there where you see it tick up, and then you're like, okay, so this is the counter move. Now we're on to the next thing, and it starts to develop a little further. So I use it for that. And I know it looks like it's something you use for buy and sell signals, but it's not really what I'm using it for. You can use it for that, and that was why I put this it's not adapt, it's, what does it, this averaging model that I came up with here, so that you can sort of track when you have it moving down, it retests, crosses over the average, and then you sort of get a buy signal. a way to filter the bounces off the multi-wop. I don't really use it, but it is a pretty good blind model of trading. Anyway, so it's for impulses and counter moves. I'm saying, when's the impulse? When's the counter move? Are we in a counter move or are we in another impulse? And you can, that's what I use it for modeling. So this morning there wasn't a counter move until here. This is all just straight impulses, just tons of trading volume, volatile trading volume. Yep. Berger said he finds about the primary info. So John asked, do you think tension by itself is enough or needs to be coupled with other indicators? I think that tension performs a function. Oh, you gotta go. You go. Go. You can go. You can go to the bathroom. You got it. You want to go to school? Yeah. You got to be able to go to the bathroom all by yourself to go to school. Okay. Can you do it? Show me. You can do it. You can do it. You need to be able to go to the bathroom by yourself if you want to go to school. Flip on the light. Saddest thing I've ever seen. So tension provides you with the scope, the landscape. I don't think it's sufficient by itself, because it's just landscape. It's just telling you what's possible, where we are. We leaned over here, we leaned over here, there are limits, what's possible, which to some degree could be enough. But I think without the context of what the players are doing, or at least some model of what's happening with participants, that landscape isn't enough. I mean, it's like watching a battle and all you see is landscape. Like, I really like to know what the people are doing. Like, what are you doing? What are you doing? Oh, they're attacking from here. They have this. And you want to watch the landscape will change how that plays out. But just having the landscape, in my opinion, isn't quite enough. It can be if, you have two armies coming at each other and there's a landscape. You could probably say, well, there's only one reasonable thing to do between these two armies, but it's an assumption, and you don't know if they're actually doing that or not. So, in my opinion, I wouldn't just trade it on its own. But if you were really good and you knew how that participants played, you might be able to successfully predict what they were going to do. But I mean, like tomorrow, we could have elasticity tomorrow, but you won't know unless you see the players do it. And so if you just guess that it's going to be elasticity, you might try and fade into a move higher. And then tomorrow morning, we don't have elasticity and the bulls come in, trap some bears and drive the market up. You're going to be underwater. So while that you understood elasticity could happen, you jumped in front of something that you didn't actually see happen. It was just a highly probable thing. And I think playing the statistics game, which is where you're like, this happens 9 times out of 10, isn't my favorite game to play. Some people like the statistics game, where you're just trying to find highly likely things and then try and do those, which in the end is just ugly stop theory. You're just trying to figure out places to get in and put your stop so that it's so ugly the market won't trigger your stop. That's really, most trading strategies are just ugly stop theory. How ugly can I make my stop so that nobody touches it? And I don't think it's sufficient, personally. I just don't think it's effective. But no, I just assume that's just me. It's just the way I think and the way I like to operate. I'm not a big fan of ugly stop theory. It just doesn't work for me. So it could work on its own, but I think you'd have to have a really good understanding of what market participants were going to do. And I doubt you would just trade off tension anyway. I think most people use 4 or 5 different tools. They follow 2 or 3 different people. They're on Twitter. They have friends and opinions and news. So it's rare that somebody's going to operate in a vacuum. And so I doubt you would in the first place. So you might say, oh, I was just using tension. But if you really step back and look at it, you probably were using like 5 or 6 different things at least to make decisions in markets. So if you were successful, my assumption would be that you were using tension to sort of give you an idea of the landscape so that you could operate more effectively, knowing when highs and lows or when things were going to turn or how far they could go. And you might accidentally attribute it just to tension, but really you were using a bunch of things. So I don't know, those are some of my thoughts on it. I think this system that is right here that we use mostly is a pretty complete system for modeling what the landscape looks like and what people are probably going to do. And then you could add other systems to it to help further filter or deal with risk and stuff like that. So yeah, I mean, it's a tool that models possibility space. Is that enough? I guess it's just a question about whether it's enough for you. It's not enough for me, but it might be enough for you.
We have to bring more milk.
So that's what we got today. I think tomorrow we're looking for that. Just keep your eye out for the elasticity, and then keep your eye out. Just that's something to watch for. If the elasticity doesn't happen, I wouldn't anticipate the market declining. I'll see you guys tomorrow.